Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China RISUN GP interim report. China RISUN Group Limited offers a diverse range of businesses and services, including production and distribution of coke, coking chemicals, and refined chemicals operation management services for third-party producers trading of coke, coking chemical, and refined chemical products development and sale of commercial and residential properties, real estate development activities. The company serves various industries such as iron and steel, non-ferrous, coking, and chemical, both domestically in China and internationally through exports. The stock price of China RISUN Group has dropped by over 22% in the past year due to a combination of company-specific financial challenges and broader negative market sentiment in China. The key factors contributing to this decline include declining financial performance, underperformance in the market, capital allocation issues, high liabilities, and broader Chinese economic headwinds. China RISUN Group's earnings per share have dropped by 22% annually over the last 3 years, with a recent 18.5% year-on-year decline in revenue and a 34.9% drop in profits. Despite significant increases in production volumes, the company faced overall financial setbacks. The stock underperformed both the Hong Kong chemicals industry and the broader Hong Kong market. The company's capital allocation efficiency decreased, with high current liabilities amounting to 56% of total assets, introducing financial risk. Broader Chinese economic headwinds also affected the stock price, including a fragile market sentiment, slowing economy, deflationary pressures, property market crisis, and renewed trade tensions. These factors have dampened investor confidence and contributed to the decline in China RISUN Group's stock price. The primary drivers of revenue growth or decline for the company can be summarized as follows. Revenue growth is primarily driven by the expansion of coke production capacity through organic growth, self-construction, and merger and acquisition, as well as the successful integration of acquired companies. Additionally, the development of new refined chemicals products and optimization of the production chain have contributed to revenue growth. On the other hand, revenue decline can be attributed to several factors, including a decrease in coke price per ton, imbalance between supply and demand, and weak steel demand. The decline in revenue from coke and coking chemicals manufacturing is also due to year-on-year decrease in coke exports. Furthermore, external factors such as continuous decline in market price of upstream coking coal have contributed to the decline in revenue. Overall, the company's revenue growth is driven by internal factors such as expansion of production capacity and development of new products, while revenue decline is primarily due to external factors such as market price fluctuations and weak demand. Net income and profit margins. A shift in the market, the net income of a company has undergone significant changes, with a decrease of approximately RMB 46.6 million or 34.9% compared to the last period, and a further decline of 38.3% from the previous year. This downward trend is attributed to several factors. On the other hand, profit margins have shown mixed results. The net income margin has decreased from 0.5% to 0.4%, indicating a slight reduction in profitability. However, the gross profit margin has increased from 7.4% to 8.2%, with notable improvements in specific business segments such as coke and coking chemicals manufacturing, 11.9%, and operating and management businesses. The EBITDA margin has also seen an increase from 8.1% to 9%. These changes can be attributed to a decrease in average price of coke products, controlled blended coal prices, and the implementation of expense reduction measures and relaxation of national environmental protection policies. The company is indeed generating positive operating cash flow. The financial summary highlights this trend consistently across 2 different pages, with net cash generated from operating activities increasing year over year. In 2025, the company's operating cash flow reached RMB 251,928, a significant increase from RMB 989,948 in 2024. This positive operating cash flow is a strong indicator of the company's financial health and ability to sustain its operations. The company's debt level has experienced significant changes over the past period. Notably, total borrowings increased by approximately RMB 4.754 billion, 15.65%, to RMB 35.126 billion as of June 30, 2025. This increase in debt levels is also reflected in a higher gearing ratio, rising from 1.9 to 2.3. In contrast, interest expenses have shown minimal fluctuations. Finance costs increased by a mere RMB 0.5 million, 0.1%, from RMB 692.8 million to RMB 693.3 million. Additionally, interest paid decreased by RMB 91.83 compared to the previous year. The lack of change in interest rate range also suggests that interest expenses have remained relatively stable. The company's financial performance was mixed across various segments and regions. Notably, Hebei Dingzhou, Inner Mongolia Hahat, Beijing-Tianjin Hebei area, Europe, and North America showed promise with planned trading opportunities. Additionally, refined chemicals manufacturing and coke and coking chemicals manufacturing performed well. On the other hand, there were no specific mentions of poorly performing segments or regions on page 12. However, the trading operations segment was identified as underperforming in pages 45 and 46. Management's outlook on company strategy. The company plans to sustain growth through continued investment in property, plant, and equipment. Despite no significant investments or acquisitions planned, management is extending the useful life of certain assets by 5-10 years due to changing government policies and operating conditions. This indicates a focus on long-term sustainability rather than short-term gains. The company's financial summary reveals a consistent commitment to shareholder value. In the past 2 years, the company has demonstrated its dedication to rewarding investors through both dividend payments and share buybacks. Specifically, dividends were paid out in 2025 and 2024, while shares were repurchased in the same periods. This dual approach underscores the company's focus on returning value to shareholders, positioning it as a financially responsible and investor-friendly organization. Concerns about inventory buildup and supply chain disruption exist. The company's financial summary reveals concerns regarding inventory buildup and supply chain disruption. Specifically, raw materials inventory has increased by 20%, while finished goods and trading stocks have also seen a rise in levels. This suggests that the company may be holding onto excess stock, potentially indicating inefficiencies in its production or sales processes. Furthermore, trade payables have surged by 38.6%, with a significant portion due within 3 months. This indicates potential supply chain disruption risks, as the company's ability to meet its payment obligations may be compromised. Overall, these findings suggest that the company should reassess its inventory management and supply chain strategies to mitigate these concerns. That concludes the financial summary for China RISUN GP. Feel free to comment below, and I will be happy to answer them when possible.